Yeah, hello everyone. Hello and welcome to my lecture entitled What's the Expected Loss when Bitcoin is under cyber attack, a fractal process analysis. So this is the final lecture, and this is live, of my data analytics course. And today we would like to talk about an application of power law functions, which is basically the main topic here of this course. Yeah? So we already spoke about it. Power law functions have been applied in scientific research across different disciplines. Yeah? So for instance, earthquakes follow or are governed by a power law distribution, and many other real-life phenomena as well. And it may be not surprising that also in financial markets, we have many different data series that are governed by this specific class of distributions. And also in finance, we have different setups or different situations that require the applications of power laws. So the history, first time that it was introduced in financial economics, or it was actually in economics, that was more than 100 years ago. In the late, it was 1897 when Wilfredo Pareto published his article in the Journal of Political Economy, which is a top-notch journal in economics. And he was arguing that the distribution of wealth is governed by a power law. So we have a huge amount of people that earn a very low salary, and we have a tiny fraction of people, they are in the tails of the distribution, which have an extremely high income. So a small fraction, like 1% of the people, have a cumulative, or make the cumulative make something like 80% of the cumulative total. So that's basically, or at least in the Pareto distribution, the 80-20 distribution, it means that 20% of the largest, of those who have the largest income make 80% of the total income. And we can break it down. If you read the book from Nassim Taleb, the Black Swan, then you might have learned that we can break down the 80-20 rule into the 150 rule. Because of this 20% of this 20% make out 80% of this 80%. And we can do this in a couple of iterations. Then we will figure out that 1% of the whole, of the total, govern basically 50% of the total. So a tiny fraction of the distribution, which is in the tails, far away from the mean, they make out a huge portion of the cumulative total of the distribution's realizations. And this was in more than 100 years ago, Wilfredo Pareto, who figured that out and formalized it. If you read his articles, you will see that they are written very well and very mathematical. So he was someone who knew what he was doing, even though he didn't get that much credit for it during his lifetime. So it was then until the 60s when Benno Mandelbrot, which was a mathematician, applied power laws for the first time to financial data. And in his context, in his research context, he was analyzing the cotton prices, or the changes in cotton prices. And he figured out that the distribution doesn't have a variance, or the variance is infinite. So which means we cannot use standard statistical tools such as ordinary least squares, which is a method, surprisingly, that is used across social science, irrespective of which data you have. This is what I believe is one of the causes, or one of the reasons for why the vast majority of scientific studies fails scientific replication. Now in finance, it's about 80%. 80% of the studies that you read in the top-notch journals fail scientific replication. What is a little bit strange is that if you go down, if you take the little bit less recognized journals, the rate of replication failures is less than in the top-notch journals. Yeah? And the reason is probably the sensation-seeking, that these top-notch journals, they are more or less sensation-seeking in the selection of the articles. There's one thing. The other thing is that it's, and I think people know that as well, but most people don't talk about it, which I think is a little bit strange. But we have this good brotherhood, right? So if you are from a university that is outside of a certain circle, then the lobby will not allow you to publish in these kind of journals. So you need first to acquaint yourself, obviously, with some people, with certain people who are in that network, and then your chances will increase that you might publish at some point in one of these journals. But given that the vast majority of these papers that are published, they have failed scientific replication, which is shown many times already. So I believe that in the future, these top-notch journals and all this lobby will probably experience a decrease in reputation, and right so. So now let's go back to our paper that I have been conducted together with some of my colleagues. One of them is Niranjan Sapkota. He's a doctoral student. He's about to graduate now. He was basically, we were elaborating the idea together, and moreover, he was collecting the data. So this paper here also has a unique data library where we basically identified 58 cyber attacks, significant cyber attacks in the Bitcoin market. Then we have here James Colari, which is one of my co-authors as well, and we collaborate since many years already on a frequent basis, and he is a US scholar, very well known, and he actually published in all of these top journals as well, and he has like 40 years experience in academic research and teaching and so on, and it happened to be that he was one of the reviewers of my doctoral thesis, and afterwards, after I graduated, I started to collaborate with James. And I consider him also already as a friend. We share quite similar values, and he's a great guy, and he knows what he's doing. Then we have Josephine, and Josephine is a mathematician. She did her PhD degree in mathematics and statistics at the University of Vaasa. Nowadays, she works in the industry in Helsinki, in the capital here in Finland. So what do we do in this study here? Always when you want to have this study in a nutshell, obviously what you do first is you check out the abstract. If you read the abstract here, it says, in the era of digitalization, cryptocurrencies have become an alternative asset for both retail and institutional investors, while the emerging digital ecosystem based on blockchain technology offers numerous advantages. It is important to be aware of potential risks such as hacking incidents. In the 2011 to 2021 period, so it's a 10 years period that we're talking about, approximately 1.7 million units of Bitcoin were stolen due to criminal activity, with losses exceeding $700 million. This paper models the distribution of stolen coins as a fractal process using power laws to estimate the expected losses from Bitcoin cyber attacks. Our results show that naive statistics dramatically underestimate the expected loss by more than 70%. Our findings have important policy implications with respect to the urgent need for cryptocurrency market oversight by governments and regulatory agencies. So, cryptocurrency research in finance has increased exponentially over the last, let's say, 5 years. This may be not surprising because you might have followed the price development of Bitcoin, which was traded last year at above $60,000. Yeah? And if you had invested only $10 in Bitcoin back then in 2009, where Bitcoin was traded about 0.05 cent or even below that, you would be nowadays a multi-millionaire. Yeah? So that's why it's obviously not surprising that people are interested in that. They're interested in figuring out, okay, what are the cryptocurrency markets about, what are the drivers, and so on and so forth. So, and there's a lot of research going on, and my own research is mainly focused on revealing the risks. Yeah? So people usually are very optimistic when it comes to new technologies. They see more the advantage and the positive side, but especially here in cryptocurrency markets, which are highly unregulated, we see new types of risks as well. Yeah? So there's one paper published in the Review of Financial Studies that will tell you that about 25% of Bitcoin transactions are associated with criminal activity, such as drugs, for instance. Okay? So in my own research, I could show that about 60% of all cryptocurrencies that are launched in the market, they eventually end up in default. Yeah? So you have a default risk when you invest in cryptocurrencies. And another point that many people maybe do not take into account is the intrinsic value of cryptocurrencies is zero. Okay, and it's common sense, right? I mean, if you have some units of Bitcoin in your digital wallet somewhere in cyberspace, and you would try to buy a bottle of beer or something in a grocery store, people would throw you out. Obviously, you cannot even buy a bottle of beer with your unit of Bitcoin, which is in cyberspace traded at $60,000. It doesn't make much sense. So many things that are happening in the world, among others in cyberspace and in the crypto space, they actually do not make much sense. And that's also one reason for why people develop the greater fool theory. So you can, which basically means or tells you that you can make profits from something that's overpriced, because someone else is even more stupid than you and will buy it to a higher price. Okay, so this paper here, it deals with cyber attacks, and as I already told you, we figured out there are at least 58 hacking incidents in the cryptocurrency market. 1.7 million units of Bitcoin have been stolen. That's 10% of the overall Bitcoin supply. Okay, and it corresponds to $700 million in lost market cap, considering the time point when the coins have been stolen. If you assume that someone else stores the coins somewhere, the market value of the 1.7 million units of Bitcoin, it's much more. It's several billions of dollars. So we have to think about also here the valuation of the losses. So this is just one thing. So again in this paper here we can have a look at the table. So to get started, here in this table here, I think it's the table 1. You see here all the hacking incidents documented from 2011 until, if you scroll down here, until 2021. So it's 1 decade of criminal activity recorded here or documented here in table 1. And the highest loss that you see here is basically, it occurred in 2014. We have to scroll down a little bit here, and what it is often referred to as the Mt. Gox collapse. So more than $400 million have been stolen in one cyber attack, And this happened on the 25th of February 2014. 744,000 units of Bitcoin have been stolen in this one single cyber attack. So if we scroll down a little bit and we check the descriptive statistics here, we see that the sample mean is 29,000 coins per cyber attack. Yeah? We see that the maximum here obviously corresponds to the Mt. Gox collapse, 744,000, and the minimum was 97 units of Bitcoin. Yeah? We see here the kurtosis is more than 3, obviously, it's 44. This already indicates the presence of fat tails, of heavy tails. So how do we proceed here in this study? So, well, we argue that if we check the largest 20%, so the largest 20% of cyber attacks make out more than 80% of the cumulative total. Because this is the case, we obviously do not deal with a normal distribution. And the only class of distribution that allows for these heavy tails that we observe here are power laws. And it may be not surprising that Taleb, in his new book on statistical consequences of fat tails, argues that there are a lot of theories on why things should be power laws as a sort of exceptions to the way things work probabilistically. But this seems to be the opposite idea, is never presented. Power laws should be the norm and the Gaussian a special case. Especially in finance, you hardly see any variables that are governed by a normal distribution. Think about the stock price or the stock market crash of October 87, where the Dow Jones, or was it the S&P 500, decreased by 29% on one day. And similar things happen all the time. Like last week, the Russian stock index decreased by 35% on one day. This would never happen if the distribution is normal. This would happen once in 300 billion years. Okay, so that means it would never happen. But it happens all the time. It happens all the time in financial markets, and people use anyways the normal distribution, which doesn't make much sense. So here you see in equations 1 to 4, the power law is formalized. We have the power law function, the probability that a realization is larger than a specific value of x, because this is a continuous function. We have to read it like that. That's the power law function, which is equal with a constant c times x to the power of minus alpha. And the c is defined, which you see, as alpha minus 1 times a minimum value of x to the power of alpha minus 1. So the c that you see here in the power law function is dependent on the exponent, as well as the minimum value, which defines from where the power law starts. If you work with empirical data, you will see that the power law is usually, it starts after a certain threshold. So if you consider here on the whiteboard, and let me just know if you can see what I have plotted here. If you cannot see it, then let me know. But here on the whiteboard, you see the simple power law function. On the x-axis, the realizations x, and on the y-axis, the probability. And you see there's a certain threshold, x minimum, for which the power law starts. Okay, so but below this x minimum value, we have a different function. Okay, so the power law is defined for a certain threshold, and this is defined here in this formula as x mean. I see here is a question in the chat. All right, it wasn't a question, it was a hint that you can see what is here on the whiteboard. Yeah, luckily my computer has an HD camera, so you should be able to follow everything here quite clearly. So the beauty of power laws is once you have determined or once you have estimated the power law exponent, all the moments are easily computable. Now you see here in equation 2, for instance, we have the expectation of the power law function, and it's simply given if you multiply it, or if you calculate it here. If you calculate, you have to calculate the integral here from x minimum until infinity. You see the power law function is defined on the whole support of x, and this goes to infinity. So you have to take the integral from this x minimum value until infinity to compute the expectation, which is the first moment of the distribution. And you see here it's defined by the power law exponent alpha minus 1 over alpha minus 2 times x minimum. So every moment is dependent on the exponent and, of course, the minimum value for which the power law is defined. And we see from equation 2, obviously, alpha must be larger than 2, otherwise the first moment is not defined. Okay? So the second moment you see here in equation 3, you see for the second moment we have, which is the expectation of x squared, and this is given by alpha minus 1 over alpha minus 3 times x minimum value squared. So and here we see the variance, the second moment is the variance, all right, is only defined if the exponent is larger than 3. This is important to know. So in Mandelbrot's case, the exponent was less than 3 for cotton prices. That's why you cannot operate with the variance if it doesn't exist. For t-statistics, if the variance doesn't exist, t-statistics do not exist either. Okay, that's common sense, or it should be common sense. It's, for some people it's not. You see here also in equation 4 that higher moments are given accordingly. It's straightforward. So the third moment is then obviously given by alpha minus 1 over alpha minus 4 times x minimum to the power of 3, and so on and so forth. Okay. So then, if you have a look here at the whiteboard, what can we do with the power law functions? Okay, so we can, for instance, we can calculate the probability that realizations are larger than a certain value x1 here, a probability of x larger than x1. And how would you do that? Well, you would take the integral from x1 until infinity times the power law function. So, and then you can do this at home. Okay, that's high school mathematics, so it's nothing special about that. If you compute that, what you then get out of it is this formula here. It's c times 1 over 1 minus alpha times x1 value to the power of 1 minus alpha, given that our c, this constant, is alpha minus 1 times x minimum to the power of alpha minus 1. It's the same that we see here in the study here. Here. So this is what you can do. And if you do that, for instance, if you want to compute the probability that a cyber attack, or let's say given, we will come back to that issue soon, but just in order to give you some information beforehand. So the probability that a cyber attack or that cyber attacks are larger or equal with the Mt. Gox cyber attack, which was the largest that we have seen in the sample, is 2.8%. Yeah? 2.8% probability. Yeah? So, and what does it tell you? Yeah? It tells you that we haven't seen the largest cyber attack yet. This is not what the data will tell you. The data doesn't know that. If you just steer on the data, and if you take the naive statistics computed from the data, you will not see that. Yeah? You will not see that coming. Okay? So that's the beauty with power laws. Yeah, you can interpolate hidden information, yeah, that is given by the power law exponent simply by extrapolation. So what else can we do? So let's say, yeah, we have the probability given. Yeah, let's say we have this given here. This is given. The probability that realizations are larger than a certain value x1 is some number, yeah, and obviously probabilities are defined between 0 and 1. Okay, we can ask us, okay, given that we know the probability, what is then the corresponding realization, yeah, for that probability, which you see here, yeah, in this graph here. Yeah? So you have given this probability here on the right hand side of the xp value, and now you want to know, okay, what is the value of that realization here? Yeah? So how would you proceed? And then we have a look here at this formula here. So what's the logic here? All right. So if we go from x minimum, if we go from x minimum until infinity, that is 1. The probability is 1. Okay? That's common sense. Where one is here. What if we subtract what we know, the probability, yeah, that x is larger than x1, if this is given, if we subtract the whole probability from what we have here, what we get is then the corresponding value for xp. This is the corresponding value. Yeah? This should make common sense. Yeah? So, and this is given by what? It is the surface from x minimum until xp. So we have to compute the integral from x minimum until xp. And again, times our power law function. Yeah? And this is not maybe that, it's quite, it's not extremely difficult, but a little bit more, it requires a little bit more calculus here. You can try this at home. I tried it in one of my own studies here, and this is basically what comes out. Okay? So if you solve that integral here, and given that you know this number here, because p from x is this probability here, yeah. So if you plug this in and you solve this equation here for xp, what you then get is this large equation here, which looks a little bit like scary. But you just, in the end of the day, you let the program do the work, you just plug in the numbers, and then you get the corresponding realization here. Okay? So, and I just realized that here is something missing, namely parentheses. Yeah? So it starts with a large bracket, yeah? And then we have here 1 minus alpha. We multiply it with another parenthesis inside the parenthesis, and there we have the a certain probability, which is 1 minus p from x, yeah, over alpha minus 1 times x minimum to the power of alpha minus 1. Yeah, and this is obviously here in the denominator. Yeah, it's in the denominator. Then we add to this term here 1 over 1 minus alpha times x minimum value to the power of 1 minus alpha. And we close the parentheses here, and then we close the outer parentheses as well, and then we take the whole expression here to the power of 1 over 1 minus alpha. Yeah, so it looks a little bit complicated, but in the end of the day, you plug it in once, yeah, and then you get the corresponding realization, xp. So why do we do that, or why is this interesting? Okay, so it's interesting for the following reason. Let's say you want to simulate how data behaves. Okay, you want to simulate the realizations for a certain power law function, and this is the way how you would do it. Let's say you have an alpha of, I don't know, 2.1, which is the corresponding power law exponent for this Pareto distribution, 80-20 Pareto distribution. If you set alpha to 2.1, yeah, plug it in here everywhere, and you say x minimum value is, I don't know, what's the minimum salary, I don't know, 500 euro, something like that. You plug your x minimum value in, yeah, the alpha. Then what you need is a random number generator, and MATLAB has that, and usually most programs, they have that. So you have a random number generator, which you need for this guy here, right? Here we have the random number generator, in order to get these probabilities here. And you have this, you just plug it in. This is constant and this is constant. The only thing that changes here is the random number generator, where you get figures between 0 and 1. Okay, and then you get the corresponding vector of realizations here, the corresponding XP. So this is something that you could easily program by yourself, or you could use another program that I will show you soon. Okay. So then, how do we estimate the power law exponent then? This is obviously an important question. If we go back here to the paper, we will see here in equation 5, we see the corresponding maximum likelihood estimator. Yeah? The alpha hat is the maximum likelihood estimator, and is defined as what? It's 1 plus n is the number of observations, times the sum from I is 1 to n, from what? The logarithm of xi over x minimum. Yeah? We sum up all of these, yeah, and take the inverse. Yeah? So that's the formula. And one thing that is now important to note is there's a whole set of maximum likelihood estimators. Okay, there's not one specific maximum likelihood estimator that you get out of that. No, there are basically, if you have n observations, you have n. Basically, you have n maximum likelihood estimators. Okay, so you have the first step is you have to compute the set of maximum likelihood estimators, and then after that you choose the one that you think is optimal, or what we will see is you can test the power law null hypothesis as well. So how would you proceed? So let's say here, if you have a look here, yeah. Let's say you have our data vector denoted as x, okay, which you see here on the left-hand side. Yeah, we have capital N observations, and we have to sort this vector here. So x1 is the observation that has the lowest value or the lowest realization, and here xn is the realization that's the largest in our data. Okay, so the data is sorted in an increasing order. Okay, so let's say you want to compute the first maximum likelihood estimator. So what you do is, okay, you take the first guy here, you grab the first guy, and as you see here in the formula, if you go back to the formula, you have to divide this guy here, you have to divide all entries here in your data vector by x1, yeah, You have to divide every entry here in the data vector by x1, take the logarithm, and sum them up. Okay? This is then in the denominator here, and what is in the denominator is n, yeah? the number of observations. And in the first iteration, you take all of your observations. Okay? Then you take out of this guy here, yeah, you take the inverse, yeah. Or no, wait, sorry. This is not true. This is not true. So you sum this up. Once again, you sum this up, and you take the inverse, which means it goes into the denominator. Okay. So this sum here goes here into the denominator, and what is in the denominator is the number of observations. And then you have to add a 1. And then what you have is the first alpha hat, the first maximum likelihood estimator. So you get a value, then if you multiply this out, you get a value, first value alpha 1, and the corresponding x minimum value is the lowest value in your data vector. Yeah? That is the first iteration. Then in the next step, yeah, the next maximum likelihood estimator is, okay, what would you do? Okay, you neglect the first guy here. You do not take this into account. You cut it out of the data vector, basically. And you take as x minimum value the second lowest number in your data vector, which is x2 here. Again, you divide every entry here in the data vector, and again it's in an increasing order here, by x2. Okay, you sum them up, put them into the denominator again. Okay, here. Then you have in the numerator n minus 1, one observation less. Okay. Then you add a 1, and that's then the next maximum likelihood estimator. Yeah? You get a new alpha hat, and the x minimum value is then x2. Yeah? So it's as simple as this. This is the maximum likelihood procedure in order to get your candidates of maximum likelihood estimators for your power law function. And of course, obviously, you would not run this procedure for all of your observations. Okay, you say you stop. For instance, you want to have at least 5 or so observations that are governed by a power law. Okay, otherwise, what can you otherwise do with that? So you usually stop here somewhere. You do not do this for all. You start usually at the lowest value, and then you stop when you come to a value that is close to the 5th largest or so. Okay, so you get then n minus 5 or so maximum likelihood estimators. That's usually what you do. So then what people usually then do is they use the hill plot. Yeah, so they plot on the y-axis all of these maximum likelihood estimators, the alpha hats, and the corresponding minimum value for x. Yeah? And what you can typically do if the data is well behaved, then you would get this function here. Yeah? If you read the paper from Clauset et al., the 2009 paper published in CIAM review, okay, then you see for simulated data it looks like that. Okay, it looks like a function that has here a saddle point, yeah. And if you have this function here, it's first increasing. Then you have here almost no increase, and then it increases again. So if you have this function here, what people usually argue is that the optimum, the power law exponent that is optimal here, is basically the saddle point here. Yeah? Yeah? It's a saddle point here. So you would choose the power law exponent that is here. That corresponds to the saddle point in this hill plot, in the alpha hat x minimum graph. But there's of course a drawback with this approach. It's first of all, it's a visual approach, and it's more like a rule of thumb, somewhat. Yeah, so it's not very accurate, and if you take if you misspecify your function, yeah, you might get misleading results. Yeah? So if the power law exponent is too low or too high, if it's too high, yeah, you underestimate large realizations. You will be obviously surprised. Okay, if the power law exponent is too low, you would think that your process is much rougher than it actually is. Yeah? So in both cases, you would make severe errors, and it is important to know that if you move from in the power law exponent below 3, yeah, it's very small change, yeah, of only, let's say, 1 digit, yeah, has a serious impact on the distribution. Okay, so you want to get it right, yeah, otherwise you end up in troubles. So, and to circumvent this, or to address this issue, Clauset et al., they proposed the so-called goodness of fit test. Okay? So, and this goodness of fit test has basically two let's say, increments. Let's talk about the first increment. So, it basically, this is just simplified here. I have a simplified way of illustrating this issue here. So let's assume for simplicity we have only 5 observations. And we have only 5 observations in our empirical sample. Using our 5 observations, yeah, we can sort them in an increasing order. Okay. And we can compute the empirical cumulative density function. Okay, so obviously the lowest, if you start with the lowest observation, if you have just 5 observations, the lowest observation is obviously then 20% of the cumulative density function. Okay, it's straightforward. So, and if you have 2 observations, the smallest 2 observations, they make out 40%, yeah, and so on and so forth. Okay, if you have all of them, they must end up to 100% in the cumulative density function. So what you can then do is, you have your empirical data, and you have your corresponding set of power law exponents and x minimum values, and what you can do is, you can, for each power law exponent that you have in your set of maximum likelihood estimators, you can estimate the theoretical probability for the realizations that you have in your data set. Okay, so let's say for the first observation, you compute your power law model, the theoretical model that corresponds to the estimated exponent, gives you a probability of the cumulative density function of 18%. The second realization in your data set has a corresponding probability in the cumulative density function of 38%. The third of 59%, as opposed to 60 in the empirical data, and the fourth has 82% as opposed to 80% in the empirical data, and the last, of course, is the same. So then what you do is, the Kolmogorov-Smirnov distance is basically the difference between the empirical data, so the empirical cumulative density function, and the theoretical. And you see, you take the maximum. Okay, because you want to know what's the maximum error between these two functions here. So, And obviously you see here the maximum is 2%. Yeah? It's between 20 minus 18 is 2, 40 minus 38 is 2, 60 minus 59 is 1, 80 minus 82 is minus 2, but if we take the absolute amount, it's 2. And you take the amount, okay, the absolute amount of the deviation, and this is here, in this case here, it's 2. And it's the distance, it's called capital D hat. It's the estimated distance, and this is equal to 2, the largest distance between empirical cumulative density function and the corresponding theoretical cumulative density function of the theoretical power law model. So you do this, the same procedure for the second estimate. You have the second estimate, the second alpha here, it's somewhere here, obviously. And you do the same again. You check, you have always the same empirical density function, obviously, okay? And then you check, okay, what would the theoretical model, what probabilities would the theoretical model predict if the theoretical model was true given the realizations that you see in the data. Again, you compute the difference, the absolute amount of the difference between the probabilities of the cumulative density functions, and you see here what's here the maximum difference. Yeah, you see it's 20 minus 25% is minus 5, and the absolute amount is 5. Then we have here 40 minus 39 is 1, 60 minus 57 is 3, 80 minus 81 is minus 1, and the absolute amount is 1. So the maximum here, the maximum difference is 5. Okay, so the corresponding D hat for the second maximum likelihood estimator is 5. So you do this for all maximum likelihood estimators that you have, okay? And then, as we always take the maximum here, but you choose then, in the end, you say the optimal maximum likelihood estimator is the one that has the minimum value of the Kolmogorov-Smirnov distance. Okay? And this also makes intuitive sense, okay? This should make intuitive sense. And one thing that you might have in mind or bear in mind is, of course, you have, if you take the whole data set, your empirical density function is the resolution is different as if you have only a few observations. Yeah, so you will usually what you will get is sort of the distribution of this D it looks something like a U usually, if the data is well behaved. Yeah. So we have on the x-axis the alpha hat, and on the y-axis the estimated Kolmogorov-Smirnov distances, and it's usually the function looks usually somewhat like a U. Okay, so this is maybe not surprising. Okay, and basically where the minimum delta hat is, okay, the minimum, that's the optimal alpha hat star. Let's call it alpha hat star. Okay. This is the analytical approach to select from the set, or to find, let's say, to find the alpha hat, so the optimal power law exponent, and that is optimal with respect to the Kolmogorov-Smirnov distance. So, and then finally, which is important in this model framework, you want to know, all right, is our power law model, is it plausible given the data that we have? Okay, so, and that's of course a valid question, yeah. And what you usually do is you could apply the goodness of fit test as proposed in the paper from Clauset et al. And how you would proceed is then, well, first you you have the optimal model here, okay? You have from this procedure here, you have an idea of what is the optimal power law exponent, alpha hat star, all right? And the corresponding minimum value for x, you have this, you can take it as given, okay? So what you do is, you take this vector and you simulate synthetic, or you just simulate, let's say, 1,000 data series in line with the model that you hypothesize to be true. Yeah? So this alpha star. And of course, each data vector will have different realizations, but they are governed by the same power law exponent. Okay? So then for what you do then is, for each simulated data series, you do the same thing that you did here for the empirical one. Yeah? But you treat now each synthetic series as the empirical one. Yeah? You do the same procedure here, okay? You estimate the hill plot, you have a set of maximum likelihood estimators, you compute the corresponding Kolmogorov-Smirnov distance, and you collect the minimum value here. Okay? And you collect the minimum value for each of these 1,000 synthetic series. Okay? Luckily, you don't have to do it by hand. It's your computer who does the job, luckily. So you get a distribution, and that's the null hypothesis distribution, because you know already, under the null hypothesis, that is, the model is true, yeah, because you have simulated it, okay? So it is the true model. And you get under the null hypothesis the distribution if the model is true, okay? What you do then is, so you have the distribution of the D's, yeah, which you see here below, yeah, and it looks sort of like a chi-square distribution. The shape is probably very close or similar to a chi-square distribution. You have a longer tail on the right-hand side. So that's the distribution of the D's from the synthetic series, okay? Let's call it DS, estimated for the synthetic series. And then you compare what is the D for the empirical series, okay? So, and you say, okay, maybe it's here. Maybe this is your D for the empirical series, yeah? That gave you the alpha star, yeah, this guy here, and then you count, okay, how much of the probability is on the right hand side, okay? If it's more than 5%, you would argue that your model is right. Yeah, so you do not reject the model because it's obviously inside of the synthetic series, okay? It's inside what you would expect. But if it's outside, if your empirical Kolmogorov-Smirnov distance is far away, and you are, let's say, we have here only, let's say, 2% of the probability mass, 2% of the synthetic Kolmogorov-Smirnov distances, then you would reject the power law model, okay? Because it's outside the 5% significance level. Yeah, usually you use a significance level of 5%. So that's a very straightforward test. It takes, of course, some time to think about it and to smelt it, but that's basically the approach how many different test statistics can be derived, even if you do not know the correct or the real distribution. If you can have an assumption. Yeah, that's the null model. You can simulate, because you know the null model, you can simulate it. Yeah, you get different statistics, different metrics. In this case, it's the Kolmogorov-Smirnov distance, and then you compare it with the empirical metric. Okay, so if you want to have 5%, then obviously, if the empirical metric is outside of this 5% of the distribution, then you would reject the null model. Okay, that's common sense. So that's how this goodness of fit test works out, and it's, I think, a very useful test in this regard, because, and this is only my own, I'm obviously not a mathematician, but I'm, let's say, an econometrician, and I would say, I usually for myself, if I think about this stuff, then I compare this with testing for co-integration or for testing for integration. Let's say, do you test for integration? If you test for integration under the null hypothesis, it's not that you do not have the null hypothesis usually that the time series is stationary. Under the null hypothesis, the time series is a random walk. And why do you do that? You do that because the error that you would do if you would treat a random walk as a stationary process is much larger than the other way around, as if you would treat a stationary process as a random walk. Okay? Same thing here. The error that you do if you would treat a normal distribution as a power law model is less as if you would treat the power law model as a normal distribution. So you want that, what you want to be, so let's say the more dangerous thing, you have it under the null hypothesis. Yeah? And it's here, you assume, yeah, because the power law model is obviously, it allows for more extreme realizations, yeah, or expected realizations. And you are risk averse, okay? So you assume that this is the correct model, yeah. So that's basically the idea here. That's the setup, and this is also how we proceeded in this paper. So let's have a look at the paper. This is exactly how we have proceeded here in our study. Yeah. We have here. Here in figure 1, you see the hill plot. Yeah, we have on the x-axis we have the minimum value, and on the y-axis we have the corresponding alphas. So what you see here from the hill plot is there is only actually one value, so it converges towards 2. Okay, so and there's one value actually. There's only one maximum likelihood estimator that is larger than 2, yeah, which is 2.03. But all other maximum likelihood estimators are below 2. So we are dealing here with a process that is close to infinite. It has a mean that is close to infinite. Next. Here we have the Kolmogorov-Smirnov distance, and of course the data is not that well behaved. So it's not like a U shape, but it's close to it at least. This is obviously, if you work with real life data, it's usually it behaves different from what you wish it to behave. Okay. So here you see on the y-axis the Kolmogorov-Smirnov distance. Yeah, this D, and we have on the x-axis the corresponding x minimum value. And we see here if in the first part of the graph, as the x minimum value increases, the Kolmogorov-Smirnov distance decreases, and it then slightly increases again, and then it decreases again. and the minimum value is reached for, you see here, between 15 and 20,000 stolen coins. So let's move on here in this study. So you see here in this section the corresponding maximum likelihood estimator that is optimal with respect to the Kolmogorov-Smirnov distance has a value of 1.99 for the alpha, and the corresponding x-minimum value is 17,000 units of Bitcoin. So now you remember from the initial equations that this would imply that this distribution has no mean. Okay? Does it make sense? No, it makes no sense, because Bitcoin supply is limited. Okay, Bitcoin supply is limited to 21 millions of units of Bitcoin. Okay, so you cannot, obviously, it doesn't make economic sense to assume that the mean of lost coins, yeah, is infinite, because it can only be at a maximum 21 million of units of Bitcoin. Okay. So what we do is we test the hypothesis that the maximum likelihood estimator, which is equal to 2.03, is optimal instead. Yeah. So we say here, okay, we test the maximum likelihood estimator alpha 1.99 against alpha 2.03. Obviously, the distance is between those is very small. Okay, it's very small, but the impact on the calculation is enormous. Okay, so we test the difference, and you see here from the paper, surprisingly, indeed, the point estimator of the alpha, it has also a distribution, of course, because it's a parameter estimate, and the distribution is normal. Okay, that is an interesting thing, and because it's normally distributed, the point estimator, it has also it has a sigma, yeah? It has a variance, and the sigma of the point estimator from the alpha is the estimated alpha hat minus 1 over square root of n. Okay, so that's basically how you can estimate the standard deviation of your point estimator, and then you get for your alpha, you can estimate for your alpha a confidence, okay, confidence interval. In the middle, obviously, is your alpha hat, and then you have 95% probability, yeah. And you know from basic statistics, yeah, if you want to have 95% probability, you take plus minus 1.96 times the standard deviation, and then you can compute the critical values of the corresponding distribution. Okay, and if you test alpha 1.99 against alpha 2.03, you just take the difference and divide it by the standard deviation. Okay, or as an alternative, you can compute the confidence interval on the right hand side and on the left hand side from your point estimate 1.99, and you can check if the point estimator 2.03 falls into this confidence interval or if it's outside. Once it is inside, you would not reject the hypothesis. Hence, you would conclude that the alpha is 2.03. Yeah. So if it's outside, if it would be outside, then you would reject the alternative hypothesis, and then instead you would say no, the alpha is 1.99 indeed. But what we get out of here, yeah, we see that the p-value is 0.56. Yeah. So what does it mean? It means that 2.03 falls into the 95% probability interval of the point estimate 1.99. So statistically, they are indistinguishably, you cannot distinguish between them, and hence we reject the null hypothesis. We cannot reject the null hypothesis, which means that the alpha is statistically 2.03. So we cannot reject this null hypothesis. Hence, we can use this point estimator, and we can then, and the corresponding x minimum value you see here, it's 18,787 units of Bitcoin. So from equation 2, we can then calculate the expectation. We know the x minimum value and the corresponding alpha hat, and then we can compute the expectation from equation 2, the expectation of x, and if you plug in these values, you will see that the corresponding amount of lost coins is equal to 647,000 coins, roughly. And this is almost 6 times or more than 6 times larger than the sample tail mean, which is roughly 100,000 coins. You see, you get very different estimates. If you just watch on the data, you think, okay, the average is 100,000 here in the tail, in this tail region, where the power law is, which is governed by the power law. But if you use the theoretical mean, you see it's much higher, because we have these extreme events, We have events that we have not seen in the data yet. Okay, that is the difference. So then, what do we do for the rest of the observations? So we have a huge amount. We have about 70% of the observations, or what you see here. It's actually we see here. So 74% of the observations are not governed by the power law. So they are here. In this region, what do we do with those observations? So because they are not governed by a power law process, we can simply operate with the sample mean. We can use the sample mean as an accurate statistic or metric to give us an estimate for the stolen coins in this region where x is smaller than x minimum value. Okay. So we can then combine these two estimates, So and then we would get we have to weight them as well, So we have to take basically, knowing that about 25% are governed by power law, and we have around 650,000 coins in this region here in the tail. But since only 25% are governed by the tail, we have to multiply 25% times 650,000 plus 75% times the sample average in this region here. Okay, that's then if you add those two sums, if you add these two figures up, what you would get is then the estimated loss based upon our model. So that is basically what we have here calculated, and we see that our model predicts that the overall expected loss is 106,000 units of Bitcoin, and this is 3 times 65 higher than the naive sample average, which is roughly 30,000 units of Bitcoin, which we have seen also in table 2. So we see if we assume a wrong distribution, we end up with severe errors. We would underestimate the expected loss by a substantial margin. So what we then here did in the paper as well is, okay, we used different methodology, different statistical tests, in order to justify that it is very unreasonable to assume other distributions. Here we use Bayes' law, which was proposed in Taleb's book from 2020. We have used Bayes' law for the normal distribution as well as for the exponential distribution, and we see, given the data that we have, it is unreasonable to assume that the data is governed by either normal distribution or an exponential distribution, even though the exponential distribution also allows for somewhat heavy tails. Yeah? But the tails are not heavy enough. What we do then is also here in the study, we use extreme value theory, and we prove, and this is shown, the corresponding table is in the appendix, yeah. So where we basically show that even if we use extreme value theory, okay, this xi. So if you use extreme value theory, you can estimate every tail observations of any distribution can be modeled by the generalized Pareto distribution. So, and based upon these based upon the shape parameter, this xi, you can infer about the parent distribution. Okay, so in this model framework here, so there are only three. All distributions break down to three parent distributions. Either the parent distribution is a Pareto type distribution, which is a power law, or it is an exponential distribution, or it is a thin-tailed distribution, that is a Gaussian distribution. Okay, so in our model, how we modeled it here, if the xi is positive, a positive xi implies a power law process, and we see here, if we take we take first 5 observations in the cluster of the extremes, and then estimate the generalized Pareto distribution using method of moments technique, the xi is positive. We add 1 observation, and we do this again and again until we use 15 observations in the tails. And 15 observations are actually what we figured out are governed here by the power law process. So we do this for all the iteratively for the tail observations, and we get all of the x's are positive. So there's no doubt that the parent distribution here in the tail is governed by a power law process, even if we use extreme value theory. But this is not something that you need to know or that you need to learn. In our context, what is important we have discussed here on the whiteboard. It is the maximum likelihood estimation of the power law exponent, and then to estimate, okay, how do we get the most optimal exponent. So this is the paper that I would like to discuss with you. Now let's have a look how to implement this using the data. I will now stop this screen, and I will share a different screen, MATLAB screen. So here you see MATLAB. I will now import some data, which is the vector of Bitcoin hackings. Yeah, let me upload the data vector here. So it's called here, it's now in the workspace of MATLAB, it's called Cyberattack vector. I will denote it, I will rename it as X. Okay. And now I have given you the maximum likelihood estimation for the power law exponent. Yeah. Let's open here in MATLAB a new script. And perhaps I need to change the screen. So I have now opened now a new script, and I will just copy the code that I have given you, the code for the maximum likelihood estimation. I will copy it just here into the MATLAB script, okay, which you see here. I pasted in. And the script is exactly doing what we have been discussing here on the whiteboard. Yeah, you can go through it by yourself at home. Yeah, so here obviously, so we store the results in a vector, in a t minus t1 by 2 vector. So t1 is 5 because I say, okay, I want to have at least 5 observations in the tail, yeah, that are governed by the power law process. So here you have the maximum estimation iteratively, yeah, for all of the for the whole data series, excluding the we do it until capital T minus 5 times, so we want to have at least 5 observations again, as I already mentioned, in the tail. So let's copy that code here. Let's copy that and paste it into the MATLAB window. I have to change again the screen. So I have now pasted now in here and just push the enter button, okay, and then I double click here on the results. So you see I have my x vector has 58 observations. 58 minus 5 is 3, so my result vector must have 53 observations. And this is what comes out here. Okay, I can mark this here and copy it into, I will now copy this guy here into an Excel file. Let's do that. Let's copy this and paste it into an Excel file. I will now again share the screen. I have to change the screen. So now you see my Excel file, and here you see I just pasted in the corresponding output. So you see here the X minimum value. So these are the coins. We know, we might remember from table 2, the minimum was 97 stolen coins in one cyber attack, and here in the second column we have the corresponding alphas, right? So what we can do is then let's just plot them. We go and insert, and we do this scatter plot. Yeah. So here we see now the alphas. Yeah, how the evolution of the alphas depending on the minimum value here on the x-axis. Yeah, you see here, yeah, the optimal. Here is the optimal value. This with respect to the Kolmogorov-Smirnov distance. You might remember it was 1.99, and the x-minimum value was 17,000 units of Bitcoin. So this guy here is optimal with respect to the, you see the hill plot as we discussed on the whiteboard here. Yeah, it somehow converges, and where it's converging, this is basically the area. The saddle point should be the area where it's the optimal estimator. But you see this data is not so well behaving, and it looks a little bit like the hill plot on the whiteboard, but not exactly because it's real data. We tested then this guy here against the highest, which is this point estimate. It's 2.03 with corresponding minimum value of 18,787 units of Bitcoin. Yeah, you see it's a very small difference, and we have seen that statistically these two guys are the same, or we cannot say that the alpha is not 2.03. So this is basically how you would do it if you use the code that I have given to you. Let's go back to MATLAB. Now we are back in the MATLAB window, and now I will just show you how you can proceed otherwise. Let's go on Google, and there's a guy whose name is Aaron Clauset. I will now share my Google screen here with you. Can you see my Google screen now? So if you put in Aaron Clouset power laws, yeah, the first thing that pops up is the website that you should basically then visit. It's called aaronclouset.github.io. Yeah, click on that, and you see research on power laws. So you see here basically Aaron Clouset and his colleagues, they have provided different packages, research, yeah, on power laws from their study. Okay. And this is also the study that I would like you to have read for this course, Power Law Distributions in Empirical Data, CM Review. Yeah? And you see here, if you scroll down, you can download different packages for power laws. So, for instance, here, download all files. This is what I would recommend you to do. Download all files, MATLAB and R. Okay, if you do that, yeah, you will get different kinds of functions, and the most interesting or most important function maybe for you, I will have it already here. I will share my screen now. So you download this package and you install it on your computer so that you can use it in MATLAB. Let's switch back to the, I will now share my screen again. We have to go back to the PDF file. So these are the important power law functions, yeah, you see here, that you can then basically get once you have installed the packages from Aaron Clouset. It's the first one is called PL-fit. Yeah, it's power law fit. So you fit a vector x for the power law functions. What you get is the corresponding alpha and x minimum value, yeah, using the optimal Kolmogorov-Smirnov distance, yeah, which we have seen on the whiteboard. Then the next one is the goodness of fit test that we also here discussed on the whiteboard. Yeah, if you use PLPVA, yeah, then you have your data vector x. You have to plug in the minimum value, and you push it silent as well because you don't want to see each iteration. First of all, you will get your minimum value from PL-fit. Yeah, because it gives you both the alpha and the x minimum value. You grab this x minimum value and run the goodness of fit test. All right. And the last thing that might be interesting is to simulate power law function, which we have also seen on the whiteboard, how to do it by hand. You have the function here, rand ht. Here you have 10,000. You have 10,000 realizations. Now, you define as x minimum a certain value here, you plug it in, and you define for the power law function a certain alpha that you have to plug in. Let's say you can plug in here x minimum value, let's say 100, and here you plug in, want to have an alpha of 2.1, yeah, and then you push the enter button here, you get a vector x that has, it's 10,000, it's a 10,000 by one vector, yeah, that has this corresponding minimum value that you determined and the alpha. And you get the realizations, yeah, in this vector. So these are basically the things, and let's just do it here in MATLAB. Let's go back to MATLAB. I have to change the screen again. Let's go back to MATLAB. I share my MATLAB screen again. Okay. So you don't even have to use my program, okay, that I wrote by myself. You can also use the program from Aaron Clouset and his colleagues, yeah, which might be even better. Or at least they are faster. So let's copy here this the first command that I told you. It's this one here. Okay, it should give you the alpha and the x minimum value for your vector x. You fit the power law function to the x vector. What you get is then here, as we have in this study, it's the optimal point estimator is alpha 1.99 according to the Kolmogorov-Smirnov distance, and 17,000 units of Bitcoin is the corresponding x minimum value here. Alright? So then, knowing that the x minimum value is 17,000, we can say, alright, let's run the goodness of fit test using this minimum value here. So again, we use this function that is provided here from the researchers. We want to have it silent as well. And the x minimum value you have to plug in now, it's 17,000, right? Yeah. So then we push the enter button here, and it says P is 58. So the P value is 0.58, and goodness of fit here is, this is, by the way, it's the difference between the empirical cumulative density function and the synthetic in the optimum. So the p-value is 0.58. Again, the p-value is larger than 0.05, which is 5%, because it's larger than 5%. Yeah, we do not reject the power law null hypothesis, which means the power law is the correct or it's a reasonable assumption. Yeah, we cannot reject that the power law model is the true data generating process for x larger than the minimum value. Okay, what next? We can now let's simulate also, just for fun. Let's use this the code. Let's say we want to have an alpha. Let's take an alpha of, just that you see the difference. The alpha is 3.0. X minimum value doesn't matter. Let's just grab here 100, and let's simulate. Let's call this here x1, just for fun. So what we then get is, if you push the enter button here, and if you push the plot x1, we see the corresponding evolution of this data series. So again, I have to change the screen here. This is a little bit slowly, of course, but let's share the screen here. So here you see the corresponding figure. Yeah, you see power law or power law exponent of 3 is usually what you see in stock returns or stock variances, sort of equities. You see this in equities, foreign exchanges. Okay, this could be a variance or volatility series of such an asset. So if we go to cotton, which is basically a commodity, we have already discussed there. We see let's take a power law exponent of 2.5 instead, and let's denote it as x2, power law exponent 2.5, and let's rerun the code, and let's plot them both together. Let's plot them both together, x1 and x2. One second. Here you see the green line is the corresponding evolution for the where the power law exponent is 2.5, and the blue line is, which you hardly see anymore, is the corresponding power law exponent for an alpha of 3. Yeah, you see here also the y-axis is different now, so you see that the we have much more extreme events, yeah, for the data series that has an alpha of 2.5. Okay, this is what you see here. So we have the extreme events are much larger. So let's go back to eViews here. I will not share it because you will see it then on the plot. I will again compute a new function. I call it x3, and I just changed the power law exponent. I will now take 1.99. 1.99, or let's say I take 1.7, let's say 1.7, and I will plot again, I will now plot the series x1 and x3. x3 is now the power law exponent of 1.7, and x1 is the power law exponent of 3.0. Again, what you see here is, okay, you cannot even see the blue line anymore. Okay, so you see here, yeah, if you now make it, if you zoom in now, does MATLAB do it here? Let's see. It works too slowly. So you cannot even see the blue line anymore. You see only this one outlier here, which is an outlier that is in the time series of the corresponding to the vector where you have an alpha of 1.7. Okay, so the whole time series is dominated by only one outlier here, and this is typical for these power law exponents or for power law functions. Yeah, once you have the power law exponent is below 2, you know that the mean doesn't exist anymore, which means that you can have one outlier that wipes out everything else in the distribution. Yeah? So this is for you to know. This is what I would like you to know. Thank you for your attention. We will now talk about the exam a little bit. Let's close this window here. Let's go back to the to some exam questions. So last year, this was 90 minutes exam. So for instance, one of these questions were related to the first lecture, of course, principal component analysis. I gave you a correlation matrix of standardized variables, yeah, that looked like this. Yeah, and then you were supposed to answer some questions here. Yeah, so it's a multiple choice test. I argue here. Okay, let us. Okay, thank you, Joseph. Thank you. I have to share. I forgot to share the screen. I apologize. So here you see the question for the exam. So there was I gave the correlation matrix here of standardized random variables. Okay, and there were obviously 4 different time series, and you see here the correlation matrix of 4 different time series of random variables. Okay, so I said, okay, they follow a t-distribution with 6.3, 6.5, 5.9, and 5.6 degrees of freedom. What's the correct answer? Then you should know, okay, what does it actually tell you here? Principal component analysis, and you have random variables that are t-distributed. So here you can then think about, okay, are the variables statistically uncorrelated? Are they correlated? Or is it so that the largest eigenvalue is close to 1? Is there only one dominant eigenvalue? Or is the largest eigenvalue close to 3? So there are different possibilities. You were supposed then to choose the correct answer. And question 2 was also related to principal component analysis. Yeah, it was the other way around. Here were on the main, above and below the main diagonal 0.99, and here it was 0. So there's obviously a huge difference. I have discussed this in detail in the lecture. You might acquaint yourself with the content one more time. Then here we have question 3. We consider the following model here. I gave you a very simple econometric model. It can be anything. And again, this is a course. This is not a course only for finance people. This is a course for social science. So this can be anything. It can be, think about marketing. You have like output, and you have something. You have sort of advertisement, internet, and newspaper or something. or whatever you have. Yeah, you have an equation here. And you say, okay, you have a parameter vector, you have the parameters alpha, beta 1, beta 2, estimated via OLS. Then here we have an error term, because it's a regression equation, we have an error term. You use the estimated residuals, you run the following model. So what you do here is, obviously, you might remember this from my MATLAB course already. So you regress the residuals, but okay, in my MATLAB course you had these squared residuals, right? So it was an arch model. But here we regress the residuals simply on lag residuals. Okay? So, and then you test if the lag residuals have an impact, so that's basically what you test here. Do the lag residuals have an impact on the residuals? Okay, if they have an impact, then obviously we have some autocorrelation going on here. So now we are in the lecture that deals with dependency structures, okay? So we discussed this in the lecture on dependency structures in the data. So then you have to know, of course, okay, let's say you have a test statistic that is lambda hat, it's 6.47. First of all, you have to know, okay, what's the corresponding distribution here? How many degrees of freedom do you have? And what is the correct inference here? Okay, so you have to acquaint yourself with chi-square distributions, because this is a chi-square distribution. Yeah, we discussed this as well in the lecture, right? And you have here that your statistical test, it says here, is the error term is fat-tailed and has the t-distribution with 8 degrees of freedom. So what is then the correct covariance measure? And then you have to think about, okay, we have also talked about that in the lectures, right? So, and then you have to apply just what we have discussed in the lectures here to the, you have to find the correct answer here. You have, again, with multiple choice, and you have to discuss what does it mean here, okay? What does the test statistic tell you about the dependency structure? You have to think about that, and then you have to come to a conclusion. So then we have some simple questions here. So if you think about in the lecture concerning Nassim Taleb's book, we're talking about medio-Christian and extremist. So medio-Christian is normal distribution. You need only 30 observations and you know what's coming, okay, with a high accuracy. If you have 100 observations, you know exactly basically what is coming. So if you have an environment that is fat-tailed or extremely fat-tailed, in the worst case, you don't even have the mean. If you have a distribution that has no mean, things become quite difficult, right? I mean, you can go home, because what can you do with a distribution that doesn't have a mean? Not much, okay? So what can you do with a distribution that has no variance? You cannot do either much, because if you have a distribution that doesn't have a variance, you will not observe the mean and finite samples, okay? So if you have a distribution that has a mean and a variance, at least theoretically, but the variance of variance doesn't exist, what do you have then? Well, you have in each sample different variance, right? So you don't observe the variance. So t-statistics, you cannot use t-statistics. So there's obviously, each sample is different from each other. So if you have a sample with 1,000 observations, doesn't tell you anything about what is happening in the next 1,000 observations. Okay, so if you have a normal distribution, you know exactly what's coming in the next sample, because the samples look all the same. So the difference between evidence of absence and absence of evidence, the discrepancy is very small if you are operating with the normal distribution, but it's huge if you operate with fat-tailed data. Yeah? Even if you say there is no evidence if you don't see evidence for an outlier, doesn't mean that there is no outlier coming. In normal distribution, if the data is normally distributed, then there is no outlier. You know that here is no outlier coming. Okay, so that's a huge difference. So then you can see here, this was more like a fun question. If you go on Mars, on the planet Mars, and you come back after 5 years and 3 billion people have died on Earth, which is the most likely reason for why they died. It's obviously not breast cancer, okay? It's not Alzheimer's either. But yeah, you can think about it. Then we have here, I gave you some example of the 80-20 rule. Power law distribution with the exponent is smaller than, in its magnitude smaller than 3. Okay, what are the implications? How much data you actually need in order to have a series, in order to be able to observe the mean? Because you remember, if you have the Pareto 80-20, the mean exists theoretically, but we don't observe him. So then we have here, I gave you here some power law process. I simulated some power law process, which is close to the 80-20. And then I gave you like different subsamples, and then you have to answer some questions, okay, about maximum likelihood estimation. Then question 8, what was it here? Again, I gave you here now, the alpha is now larger. You see, it's larger than 3. This is more what we see. That could be a variance process or the volatility of an asset. If you have the S&P 500, it looks very similar like the S&P 500 variance. And then you have the estimate. Then you have here to give a statement, which is true. Which statement is true? You have to mark which statement is true. There's only one statement true. Then you have here. This is also more like an applied question. So I gave you again. You have a power law function, and the economic magnitude of the alpha is 3.3, and you think that on 40 days the volatility is larger than 15% in a given year. On how many days do you expect the volatility to exceed 40% in a given year? Okay, so we have discussed this in some lecture. Yeah, I gave you an example. And yeah, you might think about how to apply. So I mean, this also we have discussed on the whiteboard some things, what you can use what you can do with power laws. Here, it's more that you use it as a conditional probability model. Okay, and we discussed this also when we talked about the book from Nassim Taleb. In this example with book sales, yeah? Check the example from book sales one more time, because this you might need also for the exam. Then here, question 10 was, again, you have so and so many observations, and you should test. Now remember what we discussed today, yeah? Remember that we have the power law exponent, and it has a standard deviation, okay? So you can make statistical tests. Yeah, so you have to know, okay, how does such a test look like? We have discussed today such a test in the study as well. You might remember. So you can set up different tests for your exponent. Okay, and you have to know that obviously, yeah, you have this normal distribution, and it's the test statistic. If you know you have 42 observations, and you know the standard deviation is given by what? It's alpha minus 1 divided by square root of n. Okay, so it's here in this case, you can think about what you get out of here. Okay, so the testing for the exponent, the correct value for the exponent. So then we had here some. Again, it was a lot of. It's actually only multiple choice here. And then I think this was in question here for doctoral students. Question 11, question 12. I gave you like real life data from Procter & Gamble. It's a US company, S&P 500, huge company. I gave you here data, and then you should acquaint yourself JB test, with the testing for normality, and I gave you here different subsamples. Okay, and then you should come to a conclusion. You should just comment on it, and you should figure out, obviously, that what you see is in the data is not usually the whole story. Okay, masquerade. Check out the masquerade problem. So then question 13 was again OLS, and it was a little bit more difficult here. But again, I think this was for doctoral students. So you had this model being given, and you have to then do a test, and then you have to derive the covariance matrix. So I recommend you to do to use the in Microsoft Word. You have the function, right? You can easily write functions there with the function app. Then question 14 was about, again, I gave you a model, OLS model, error term, and then you should do some hypothesis testing for the error term. Question 15 as well, and this was even a little bit more. You are doing many different tests here after each other, so you have to be familiar with tests, statistical tests, chi-square tests, how many degrees of freedom, okay, what's the critical value here, is it significant, yes or no? And yeah, it's actually quite straightforward. I mean, if you have taken my MATLAB course, then it should be straightforward. For those of you who have a technical background, you probably know this anyways already. It's probably elementary school for you. But yeah, this is how the exam basically looked like here. Last year, this year, it will be very similar. I can promise you. And now I'm wondering if there are some questions. It's Friday, and I think we have been good in time. It's 8 minutes before 4. And if you have questions, you can let me know now. If there are some things unclear or everything is crystal clear, then probably everything is fine. If you have some questions, otherwise you are now welcome to ask. Otherwise, I would suggest that we have the exam. I will try to put this online, that you can have a look at it if you need one more time at some point. I don't know if I manage on Monday. Otherwise, let's see how we proceed with that. Otherwise, I would ask you, okay, when would you like to have the exam? So here I have some questions here in the chat. The Moodle is the test on Moodle. No. The exam, it's an exam, and the exam will be an open book exam. Open book exam. So I will send you the questions via email to those of you who register, and then you are welcome to participate in the term paper, and you have to send the term paper then after 1.5 hours or so back to me in time. And so then I have another question. I think I will let you decide if you want to have a grading or if you want to have pass or fail. Obviously, if you care about the grades, then you want to have 4 or 5 or something, at least 3. It depends. So I think I will let you decide. I will give you a grade, and then you have to to decide if you want to have the grade or if you want to have just pass or fail. This is basically how I would like to proceed here. So that is, I think, because I think it's maybe not. Last year it was master students did better than doctoral students. Okay, doctoral students had also a little bit more difficult questions. Okay, so there are some questions are for master students, others are for doctoral students. Okay, so they are for doctoral students are a little bit more difficult because you are doctoral students. Okay, so you should be much more familiar with statistics and yeah, I mean it's the common sense that I can expect more from doctoral students than from master students. So this is basically how it looks like, how I would like to proceed, and of course this is the course where you were supposed to do something, and those of you who are studying on the Graduate School of Finance in Helsinki for the finance program, you know that these courses are also not the easiest ones, but the learning outcome is huge. It's enormous. Hopefully, this is the same here for this course, that you learn something that you find useful and that you can apply in your own, maybe in your own research, maybe in your master thesis, maybe later on when you are, maybe some of your research papers you might use these stuff. I published now a few papers using this methodology in different contexts and have much more papers to come. So fractal finance is based upon this. This is one thing is about these distributions, the other thing is about dependency structures, which I didn't cover here. Dependency structures for power law processes. This is something that I might, in the future at some point, maybe I will create a new course for that, I don't know. But that's a new area, or it's not really new, but it's sort of still more is coming, and it's more advancing. I suppose in the wake of this crisis now, people will be more aware of that these events can happen, and they wipe out all gains from many years. So we have to account for these outliers, these low probability events that have a high impact. All this is not in standard models. That's why hedge funds blow up. That's why scientific research fails. Here, you have only one exponent. You have only one parameter to estimate, and you can get a lot out of it. And then you know what to do with the data. At least it's more reliable than making wrong assumptions and using models that simply don't work out. Okay. So yeah, that was it from my side. It's 4 o'clock. Hopefully you had found it interesting. If you have more questions, you may drop me an email. Otherwise, I would schedule the exam. I will let you know via Moodle, of course, but I would schedule the exam so that you might have more time to learn. Because now you know, obviously, what I focus on, in what kind of questions might come. So I would give you 2 more weeks time, and the exam would then be around 15th of March. If it's too early, if you would like to have it in the end of March, let me know now. Otherwise, I will schedule it on 15th of March. All right, thank you for today. Thank you for your attention, and have a good weekend.